balance sheet is a core financial statement that provides a snapshot of a company's financial position at a specific point in time. It summarizes what an entity owns, what it owes, and the owner's or shareholder's stake. The balance sheet is an essential tool used by executives, investors, analysts, and regulators to understand the current financial health of a business. Balance sheets allow the user to get an at-a-glance view of the assets and liabilities of the company. The balance sheet can help users answer questions, such as whether the company has a positive net worth, whether it has enough cash and short-term assets to cover its obligations, and whether the company is highly indebted relative to its peers. The assets should always equal the liabilities and shareholder equity. This means that the balance sheet should always balance, hence the name. The foundation of a balance sheet relies on the fundamental accounting equation. Assets equals liabilities plus shareholders' equity. Assets are resources a company owns, or controls that hold measurable monetary value. They are divided into two main categories based on liquidity: current assets and non-current assets. Current assets are all the assets a company expects to convert to cash, sell, or consume within 1 year or one operating cycle. Current assets are typically grouped into multiple categories on a balance sheet: cash and cash equivalents, accounts receivable, inventory, etc. Cash and cash equivalents. The most liquid assets, including physical currency and bank deposits. Accounts receivable. Outstanding invoices or money owed to the business by customers for goods or services already delivered. Inventory. Goods available for sale, and raw materials which the company intends to sell. Non-current assets are illiquid company resources expected to provide economic benefits for more than 1 year. They are capitalized rather than expensed, meaning their cost is spread over their useful life through depreciation, amortization, or depletion. Non-current assets are categorized into three main types: tangible assets, intangible assets, and long-term investments. Tangible assets. These are physical items used in business operations, such as land and buildings, machinery and manufacturing equipment, office computers, vehicles, and furniture, etc. Intangible assets. Non-physical assets that provide long-term competitive or financial value, such as patents, trademarks, and copyrights, intellectual property, and proprietary software, etc. Long-term investments. Investments held for extended periods that will not be liquidated within 12 months, such as real estate held for investment, stocks and bonds in other companies, etc. Liabilities are financial or legal obligations owed to another person, business, or institution. In accounting and personal finance, they represent what you owe, such as loans, mortgages, or accounts payable. Liabilities are typically categorized by when they are due: current liability and non-current liability. Current liability. Obligations that must be settled within 1 year, such as accounts payable, payable tax and short-term debt. Non-current liability. Debts due over a period extending beyond 1 year, such as long-term debt and loan. Equity represents the net worth or ownership value of a company. It is the residual interest in assets after all liabilities are deducted. Following the foundational accounting equation, equity equals total assets minus total liabilities. A capital account on a balance sheet is an accounting record that tracks an owner's or shareholder's financial stake in a business. It represents the net worth and ownership equity of the entity, calculated by combining initial investments, additional contributions, and retained earnings, minus any withdrawals or losses. Changes in the capital account directly reflect the economic health and growth of a company. The main factors that adjust the account balance include initial investments, additional contributions, net income or losses, and drawings or distributions. Initial investments. The starting cash or assets provided by the owners. Additional contributions. Any extra funds the owners inject into the business to support operations or expansion. Net income or losses. The company's profits or losses allocated proportionally. Drawings or distributions. Money or assets withdrawn by the owners for personal use. Investors and managers use the balance sheet to assess a company's liquidity, debt levels, and overall stability.